We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Simon Hunt. He's a consultant in the global economy, China, and the copper industry. How are you today, Simon?
Good, thank you.
Excellent to be able to speak with you today. So when we take copper, for example, will these current high prices last, in your opinion, or will utilities, for example, try to substitute them because of these high prices?
Good question. Copper's become part of the money game. It's not been industry that has driven copper prices higher. In fact, since around $7,000, the industry itself has stepped right aside, not been involved, not bid up prices. It's been the funds, the algos, speculative activity, etc., etc. The probability is that for one reason or another, we'll have one short-term spike up, probably over the next 2 or 3 weeks. And then the likelihood is that we will have a big correction during the summer months. The question of substitution is arising. The real issue is the utilities determining whether this is a short-term phenomenon or whether over the coming 5 to 10 years, prices at around 10,000 or over are here to stay. Already in some parts of the world, the power utilities have already decided to specify aluminium. And this includes China, not on a wide scale yet, because the state grid is reviewing its options. But I understand very quietly that some tenders are being issued to a few of the top cable companies in which they are specifying Ali. So in general, the position with the state grid in China is that they are reviewing the situation. But the fact that they've already started to issue quietly, unpublicized, Ali for distribution cables is a big signal. This is very important because globally, distribution cables consume around 5 million tons. A second big item of substitution is in EV cars. Aluminium for some of the wiring is being specified, and the loss is something like between 25 and 30 kg per vehicle. I could go on. There's a new tested graphene wire conducted by a university in northwestern the United States in conjunction with General Motors. And that so far has been very successful. And what does that do? It improves the conductivity and therefore it reduces the weight. And for the EVs switching to Ali, it's a weight issue more than a price issue. The lighter vehicle travels further. So high prices always lead to innovation. And in the last period of innovation, of high prices, you had all sorts of research being done in nanotechnology, nanotubes, et cetera, So if these prices do stay with us, as many of the funds think is the case, then you're going to see serious substitution. And the prices that are being forecast simply won't arise.
It brings to mind the idea that, there's no cure for high prices like high prices. And I know back in 2013, even back then, you wrote that the copper game is all about the monetary game. And you were saying that that's equally true today. And another...
You've done some research.
I like to try and be prepared for my interviews, Simon. But something else that kind of comes to mind is people that have said that copper is really a barometer or a bellwether for the world's economy. Is that maybe backwards, like from your point of view?
That used to be the case. But since the last spike in copper prices when did it spike? 2011? Mm-hmm. Whenever it was, that's not been the case because of substitution and because the money game.
So in your report, Simon, you predict that the copper price, for example, sometimes you're trying to predict it for years to come. So what tools help you to make these predictions?
The biggest tool is how we see the world economy evolving, not just over the short term, but over the medium and long term. And then with that, we fit in technical interpretation of events and marry the two together and come to our conclusion.
So also in your report, Simon, you say that there's been a 41% increase in raw material prices since May of last year. Is it raw material?
In China.
Yes, absolutely. So, but they're trying to figure out that is it raw material consumers replenishing inventories or investment and speculative activity or indeed manipulation? So how do you see that and how are they going about trying to figure out the answer to that question?
I think they've probably already figured it out.
So how did they go about trying to figure that out, whether it was manipulation or speculation or just pure demand?
Simply because they would have chatted around consumers. They already have some players under investigation. So there's a lot that they already knew. What are they going to do? The most important method, which they have been pursuing for other reasons, is slowing the economy down. Because their focus is no longer on growth. It's on preparing for the hard times ahead. So that means they are reducing debt, deleveraging balance sheets, and preparing for the difficult times. The absolute converse to what the West is doing. They are pursuing orthodox monetary policies in complete contrast to the fiat policies led by America.
Simon, you're saying that although the consensus is optimistic that the second half recovery will be strong, second half of this year, we believe that it will be quite muted. What are your reasons for that?
The biggest reason is inflation. Inflation will burn off a lot of the fiscal and monetary stimulus. There was the example in America of personal income from all sources, which in year-on-year basis rose by 0.5%, allow for inflation, and it was minus 3%. That's a big switch.
So that's what you mean when you say that inflation is going to burn off any quote-unquote growth, because it's actually put in real terms, it ends up
stagflation. It's stagflation.
Mm-hmm. You're also predicting that the markets will start to sense the imminence of a global financial crisis in 2024, Simon. What will be the catalysts to bring this on?
No one ever knows the real catalyst until it arrives. But it's our long-held belief has been that the world cannot go on as it has done for so many years with debt growing faster than GDP. And our sense is that in reality, the Western central banks are deliberately blowing up the system so that at the appropriate time, they can introduce a different structure, which basically will be a washout of debt, probably digital introduction of digital currencies, and a world dominated by equity and not by debt. The interesting thing is that China and Russia are in the lead here. They're preparing themselves. They are reducing their holdings of dollars, directly or indirectly. They are far more advanced in introducing their digital currencies. No, we always thought that China would be introducing its digital currency in 2023. The signs are now it could easily be this year. What's also interesting is that China has huge quantities of gold, in total something like 38,000 tons, of which 20-odd thousand tons is owned by the government, of which only a small portion is owned by the PBOC, and the 18-odd thousand is actually owned by the public. So at some form or another, gold will be part of the RMB. And Russia also has much larger holdings of gold than is being reported, something like 12,000 tons.
So is it possible that the launch of this digital RMB is part of China's offensive strategy against the US, Simon?
Offensive or defensive, whichever way you like to look at it. And it's really only the first stage. Well, first of all, they have no wish for their currency to become a world reserve currency. That's not part of their whole political thinking. They're not after becoming the sole, they are not after taking from America its hegemony status. They are looking for a multilateral world. So the next stage, when they've cleaned up their financial system, is to say to the world, you want to sell to us, we pay for you in our own currency, or in some other currency than the US dollar. So that's annual imports, roughly 2.1 trillion. It's a lot of money, a lot of dollars that will go out of circulation. And probably it will lead to other countries, particularly Russia, but many other countries following suit, mostly centered around the 160-odd countries that form the BRI.
So, Simon, I'd like to go back to something that you touched on earlier, and you were saying that China is basically now changing their strategy away from growth, really trying to live within their means, reducing debt at all levels, and cleaning up their balance sheets. So, again, you mentioned that they were doing this because they see the possibility of hard times ahead. What is this in part due to? Is this, basically bracing for the consequences of the West's huge fiscal and monetary policies that have been in play for so many years here?
Basically, yes. You listen to some of the top advisors to the government, such as the ex-deputy governor of the PBOC and deputy managing director of the IMF, actually saying America's fiscal and monetary policies will result in high inflation and bubbles being created across the world, that we have to prepare for that. And obviously, the end result of that scenario is a crash in the financial system. So they are preparing for it. It's quite interesting. There was an example very recently that of a couple of high-speed train projects which had been cleared, and then cleared in January, and then in May got cancelled because they found that the railway companies had too much debt. The project would only add to debt, and that it would only add to the hidden debt of local governments. In April, there was a very strict edict issued to local governments. You've got to live within your means. We're not going to back you up if you fail. So it's serious. And that's why growth will disappoint this year.
So is America outright, let's say, trying to curtail, if not destroy, China's growth? Or is this something that they have decided on their own to try and shift away from?
Well, the first part is the correct answer, in that America wants to destroy China's growth because they see that if China continues its policy of growing faster than America, and with the introduction of a digital currency, that it would destroy America's domination of the world. So what China is doing is a response to what America is endeavoring to do.
So how does the introduction of the Chinese digital currency really advance their plans and their strategy against the US?
Because it makes the RMB more acceptable to central banks.
And as part of that, Simon, what role is gold going to have in their new digital currency world? Is it just going to back that currency, or how do you see that being used?
I wish I could answer the question. I don't know, but it's bound to be involved in the digital currency in some form or another. It's such a powerful tool, and it's one that's so acceptable to so many countries, central banks.
So, Simon, how is this going to affect the US dollar in both the shorter term and longer term here?
Well, short term, the world is negative on the dollar. The PBOC does not want a rapid increase in the RMB, and they issued some instructions to their financial institutions. So I think we are going to see pretty soon a sharp bounce in the dollar, which will take a lot of people by surprise. One reason why commodities will have a correction. Longer term, taking us up to the mid-2020s, the dollar index is likely to halve in value. That may sound a very aggressive forecast, but if you look at what's going on in America, who wants to hold dollars? A divided nation, law and order is hardly existing. You have these huge fiscal and monetary stimulations. Put that all together, plus many countries outside the G7 really looking at America aghast. So I think something around halving by the mid-2020s is aggressive, though the forecast might be, I think is very reasonable. And it fits our technical analysis as well. That means that more or less at the same time, you will see a 40-odd% hardening of the RMB against the dollar.
Simon, you were also mentioning that that is going to come along with a correction in the commodities. Is this likely to last? And in your newsletter, you talk about this super cycle. Is that the commodity super cycle that you're talking about?
There is an economic super cycle and there is the copper super cycle. We did work back to 1900 and found that both global economic activity and copper consumption actually moved in 40-year-long cycles. We came out of the low super cycle at the end of last year, and the move into the new super cycle is being interrupted by the short-term cycle, the collapse of the economy, the collapse of the financial system. So post, say, 2026, 2027, we will move into the new super cycle with GDP, global GDP averaging around 4% and copper consumption 4 to 5%. So that's the broad parameter of our interpretation of the super cycles. The financial community keeps talking about the new super cycle for copper. And my response is they are assuming that what is being forecast for 2030 is here today, without taking note of short-term cycles. So we've got a cycle, not a super cycle now. And the business cycle will turn down probably starting late 2023, leading into the big crash. Then we have the real super cycle. But by then, you'll have substitution in many applications coming to the fore. So some of the big numbers being spoken about, copper consumption growth, will be defused. They'll be good numbers, but not 6, 7, 8%.
Not what's being forecasted at this moment to really step into, as you're saying, this reality that is going to be 2030, which is not here today, right?
Correct.
So Simon, looking forward to, let's say, the start of this new super cycle, let's say 2025, 2026, what role does China play in that versus the US? How different does the landscape look? I know that's a long ways out and there's a lot that can change, but how do you see that?
I'll answer it a different way. China is preparing for the crash. The Western world is not. China will be in a position to pick up assets that they would like to own in a market where nobody will be able to oppose them.
That's a very profound statement, Simon. And I don't know that it leaves a lot of confidence in the West. You point towards something that was called the longer telegram towards a new American China policy. What was this report, and can you lay some of its most significant points out for us?
It was a report that was issued, I think it was the 21st of February. It was an Atlantic, one of the think tanks, big think tanks in Washington. It was written by, as they stated, an expert on China at a very senior level. And I read the report, and it was, the gist of the report is we have to control, if not destroy, China. And it was written in such a way that you could only assume, having read the report, particularly the preface, that war is a real possibility. It's the pivotal point, Washington, if it wants to retain its hegemonic status, both for the dollar and politically.
So, Simon, what is the credit impulse cycle? And does it typically mark a turning point in economic activity in China?
Not just China, globally. Yeah, it marks a turning point. And what was interesting is that its peak was in the fourth quarter of last year, running at plus 9% of GDP. And if certain senior financial people are correct, it would be minus 3.5% by the end of this year. So what we're seeing at the moment is the positive impact of the impulse for economic activity. But if you look at between January and April, at January and May, the monetary figures, the total social finance figures, they've cratered. So you're going to see slowing activity as the year progresses. You may see a more positive response in the fourth quarter because it's another political year, 10th anniversary of President Xi's presidency. So you may see some pickup late this year, leading into better but stable economic performance in 2022.
So does that play a role in their plan going forward about bringing their balance sheets back into check?
It's all part of the same, yeah.
So it's not necessarily, let's say, just a cyclical trend, but...
No. It's a long-term trend. But within the long term, you can have years where you will see better performance. And being such a political year, we'll probably see better performance. But 2023, the gloves will be off.
Something I'd like to get your opinion on as well, Simon, as you're talking about timelines here. You know, elections and the unrest that are in South America, which is mostly where a lot of the copper production comes out of in the world today. How is that going to affect the copper price and, you know, overall production coming into like this period of unrest here that we're seeing?
First of all, we don't know the result of the Peruvian elections yet. It's a close-run thing. Castillo, the left-wing candidate, is slightly in the lead at the moment. But the votes from Peruvians living abroad has yet to come in, and that could tip the balance. But generally, there is a move to the left in South America, Chile as well. So how permanent that move is going to be, I can't forecast. It's perfectly possible that people will see, goodness, we've moved from one form of government to another form of government. I'm not sure I like this new government form. So short term, yes, it will be a positive for copper prices. But then you come down to the real, will it be enough to balance big fall in copper consumption, which we are likely to see 2024, 2025.
And Simon, something you and I were speaking about before we hit record here, in the same kind of geopolitical vein, when we're coming up to the 100th year anniversary for the Communist Party of China, what is the US likely to do coming into that? What kind of events could we see?
I think you are going to see between now and during the anniversary, which is in July, you are going to see tensions increase. Washington will do everything it can to pour cold water on the celebrations. I don't know what they will do. It could include something to do with Taiwan, but the expectation is that America is going to do everything they can to pour cold water on the celebrations.
Simon, something that kind of struck me during the interview here was, maybe a little bit out of left field for you, but where do you see cryptocurrencies playing a role in this, world going forward? Do you see any utility for Bitcoin? And
I have no view whatsoever.
Okay.
Sorry.
Not a problem. That's an honest answer, and I appreciate that. Simon, do you have anything else you'd like to add or leave our listeners with before we wrap up here?
I think, just to summarize, there is likely to be a catalyst in the coming weeks, which will lead to sharp corrections in equity markets and sharp corrections in commodity markets. We may see the bottom of those corrections in the fourth quarter. They will be buying opportunities because the corrections will cause more stimulus to be given to economies in the West. So we'll have new highs in equity markets. We'll go from, say, 8,000 to a spike of 14,000, probably in 2023. And then we have the global crash. So everybody has 2 years to prepare themselves. That includes mining companies.
Is there a particular, let's say, reason for that timing of 2 years, that 2023, 2025 global crash, Simon?
It's partly fundamentally driven and it's partly technically driven. Fundamentally driven, you cannot have global debt continuing to increase faster than global activity. And there comes a time when the central banks know that they have to restructure. And we've logged that period in as mid-2020s for a long time.
Excellent, Simon. For any of our listeners that want to, let's say, get in touch with you or learn more about your consulting company, that's available at shss.com.
Actually, we are better to have Simon at shss.com.
Okay, excellent. Simon, thanks very much for your time today. I really appreciate it.
Thank you. I enjoyed it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.